Q2FY25 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DM Capital Advisors Limited. Thank you, and over to you, ma'am.
Yeah, thanks, Steve. Good morning, everyone. Warm welcome to the Q2FY25 earnings call of Kalpataru Projects International Limited. We have the management today being represented by Mr. Manish Mohnot, Managing Director and CEO, Mr. S.K. Tripathi, Deputy Managing Director, Mr. Sanjay Dalmia, Executive Director, Mr. Amit Uplenchwar, Director Group Strategy, and Mr. Ram Patodia, President Finance and CFO. At this point, I'll hand over the floor to Mr. Mohnot for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Thank you, Bhumika. Good morning, everyone, and thank you for joining us on the call today. Let me first provide a quick update on the operating context. Post that, I'll move on to our performance and key highlights of each of the individual businesses. Post the last interaction for the Q1 earnings conference, we have witnessed noteworthy improvement on the execution front, with improving labor availability and moderating working capital intensity compared to Q1 of FY25. Our T&D, building and factories, oil and gas, and urban infra business, each at individual level have reported YOY growth in excess of 20% for first half of 25. Our water business has remained subdued, which we expect will moderate the overall growth to some extent, but not significant. We have also completed the signing of definitive agreements for sale of Vindhyachal Expressway, VEPL. We expect to close the deal post receipt of necessary approvals from concerned authorities and lenders in the next few quarters. As far as business landscape is concerned, government plans for infrastructure development, including the transmission and distribution capex, is getting better and firmer as we are progressing ahead in the year. In this backdrop, we have secured record order inflows of rupees 11,865 crores, including 835 crores announced yesterday. Nearly 90% of our order inflows are from T&D and B&F business, in which we continue to improve our capabilities and strengthen our market position. Additionally, we have an L1 position in orders worth 7,000 crores. More than 75% of this L1 position is in the domestic T&D business. Our consolidated order book stands at rupees 60,631 crores at the end of September 24. Our order book remains well diversified across businesses and markets, which depicts inherent strength of our business model. Now, moving on to the performance. We have delivered yet another quarter of good performance marked by growth in turnover, improved profitability, moderation in debt levels as compared to June quarter. We reported a consolidated revenue growth of 9% both for Q2 and first half of 25. Our consolidated revenue reached rupees 4,930 crores for Q2 and rupees 9,517 crores for first half of 25. The revenue growth is largely driven by improved project progress and healthy order backlog in our T&D, B&F, oil and gas, and urban infra business. Our consolidated EBITDA margins improved by 70 basis points YOY to reach 8.9% for Q2 25. Our consolidated EBITDA was up by 18% YOY at rupees 438 crores in Q2 25. Similarly, our consolidated PBT grew by 42% YOY to reach 188 crores, and PAT was up by 40% YOY to reach rupees 126 crores for Q2 25. For the first half, consolidated PBT reached 325 crores and PAT at 210 crores. This improvement in margins is driven by a combination of robust execution, healthy project mix, and diversified business profile. Our consolidated net debt declined to rupees 3,668 crores in September 25 compared to rupees 3,739 crores in June 24. Our consolidated working capital has declined by 5 days compared to June quarter to reach 98 days at the end of September 24. Our standalone revenue was up by 8% YOY and stands at rupees 4,000 4,136 crores for Q2 '25. Our standalone EBITDA margins grew by 40 basis to reach 8.4%, and PBT grew by 15% YOY, and PAT was up 17% YOY for Q2FY25 standalone level. Our standalone net debt declined by rupees 114 crores QOQ to reach rupees 2,973 crores for period ended September 24. On the individual business verticals front, first starting with the T&D business, our revenue grew by 25% in Q2 '25, driven by robust execution and strong order backlog. So far, we have secured orders worth approximately 6,000 crores in the current fiscal year in T&D, with an additional relevant position of rupees 5,500 crores. On the international front, performance in Sweden and Brazil saw significant improvement compared to the same quarter last year. At Ingemundas in Sweden, Q2 revenue reached rupees 380 crores, up by more than 100% compared to similar quarter last year. Our order book at Ingemundas stood at record high of rupees 2,958 crores as of September 24. In Brazil, Fasttel reported rupees 285 crores in Q2 revenue, reflecting a 48% YOY increase. The order book at Fasttel stood at rupees 828 crores at the end of September 24. Our overall T&D order book, including international subsidiaries, stands at rupees 22,269 crores as of September 30, 2024. The business outlook remains positive with a robust tender pipeline in both domestic and international markets. Our P&F business achieved revenue growth of 19% YOY in Q2, driven by a healthy project mix and improved project momentum. We have secured orders worth rupees 4,500 crores to date in FY25. Our P&F business order book stands at over 13,000 crores. In Q2, we have secured some prestigious orders in design build, luxury housing, and airport segment. Moving on to the water business, our revenue dropped by 43% YOY in Q2 '25 due to delay in collections in a few states, which impacted execution and project progress. We are closely working with clients for improving the collection cycle and scale up project execution. The business has witnessed slowdown in tendering activity post-elections. However, we have a strong order book position of rupees 10,500 plus crores as of 30 September 24, ensuring good visibility for the next few years. In our oil and gas business, revenue grew up by 170% YOY to reach rupees 463 crores in Q2 '25. The growth was largely in account of improved execution on existing projects and start-up ramp-up projects. Our order book in the oil and gas business stands at rupees 8,474 crores, giving a good visibility going forward. In our railway business, revenue dipped by 40% in Q2 '25. As reiterated in our earlier calls, we are staying cautious and selective in our bidding approach, given the intense competition. Our priority in railways is to complete the existing projects on hand and reduce the capital employed of the business. In the urban and infra business, revenue grew by 31% in Q2 '25, driven by stronger backlog in the metro rail sector. We are focused on elevated underground metro projects, bridges, flyovers, elevated road corridors, and tunneling works. Our order book in the urban infra business is at a very healthy level of 2,600 plus crores, and we expect that order book to improve further. In our road BOOT projects, daily revenues increased to rupees 56.5 lakhs in Q2 '25. In the first half of '25, we invested rupees 39 crores in road BOOT projects, primarily for debt repayment. As mentioned earlier, we signed an agreement to divest VEPL for an enterprise value of 775 crores, with expectations for the deal to close in FY26, subject to requisite approvals and closing adjustments. Given a healthy order book, improved visibility on project fronts, a diversified portfolio, along with a strong execution team, we are confident of delivering healthy growth with improved margins from Q3 onwards. With that, I'll wrap up my opening remarks. I'd also like to extend my warm wishes for a happy Diwali to you and your loved ones. I would request now the moderator to open the line for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bharat Sheth from Quest Investment. Please go ahead.
Hi, congratulations Manish ji and team on a very good result. Manish ji, I have two questions. First is on if you really look at our core EPC business, which has grew as per segmental report by around 10% and EBIT has also improved by almost 53%. So how do we see this business going ahead, kind of a traction that we have based on the order book?
So, good morning, Bharat. I think, typically Bharat, Q2 is always a subdued quarter when it comes to EPC execution, given the monsoons, given all of that, right? The good part is that across all businesses now visibility is very, very good, except railways where we have consciously taken a call. I believe going forward, we should be doing much better in terms of delivering on our projected numbers, delivering on our budgeted numbers. And also the next 2 quarters visibility on every front is very good, right? Whether it is cash flow, whether it is labor availability, whether it is a wide mix of portfolio. So I think growth as well as improvement in margins is visible. We've also said in the past that margins are going up because the entire new order book which we've got over the last 2 years is obviously at better margins than what we had from the past. And that impact you should see it coming in, you've seen some portion of it coming in Q2 and you'll continue to see that over the next 6 days, if not more than that quarter. So our own belief is that from a 2-year perspective, I think growth and improvement in margins is visible. And we should be able to deliver at least whatever we have committed in every form. Yes, we have faced some challenges in the first 6 months, primarily in water business, right? And as I explained earlier, that that's something which is beyond that because we have not been able to connect anything in a few states, right? It was the election drive, it was the government change, whatever. We've been in continuous touch with them, and whatever we've lost in the first 6 months might not come back in the current year, but on an overall front, that's something which will be delivered going into the next year.
Is that, based on your comment, is that again, on this standalone our core EPC business, slowly we see the reduction in the borrowing, correct?
Yes.
Okay. And sir, would you like, yeah.
Typically, our business first 2 quarters, you'll see always borrowing working capital being high. It's slightly higher than what we projected for us because given the corrections which got delayed in the water business. Pretty confident that going forward Q3, Q4, the debt levels will only come down from where we are today. It will not go up. And we stand committed to, keeping the working capital days below 100, even at a standalone level by the end of Q4.
That's a good, sir. And would you like to revise our order intake growth as well as the top line growth?
So, clearly, as far as order intake growth is concerned, we stand committed to the numbers which we gave earlier. Right? So the focus right now is improving margins because we have a very good visibility on order book. So while today we have visibility of around 17,000 odd crores, including L1, we believe that for improving margins, even if you have to compromise slightly on the absolute value, we're happy to do that. So we stand committed to the same number, 22,000-23,000 crores. We will revisit that number at the end of Q3 once we have more visibility coming through. As far as revenue growth is concerned, I think Q3, Q4 will be very healthy, and I think that will help us deliver healthy growth compared to what we did in the previous year. We definitely could face some challenges on whatever we've not been able to achieve in the water business in Q1 and Q2. But on an overall basis, we still believe that we'll see healthy growth going forward.
And last question, sir, on order inflow. In first half, we have seen that mix changing towards the domestic. So strategically, are we, focusing more on a domestic in view of geopolitical problem? Also, if you can like to say throw more color on that?
I do not think consciously we are doing anything driven by geopolitical. Yes, we continue to be risk averse on areas where we don't have things to go from bad to worse. The T&D growth in the domestic front was visible right from March, April onwards, and those have got converted now. We continue to stay bullish in the international front also, but we continue to be risk averse based on the volatile environment. So I wouldn't say strategically it changes a lot. You will see international order book going up in Q3, Q4. But for us, I think more important butterfly is looking at the return ratios more than anything else. Because today everyone has a healthy order book. Wherever margins are good, where we can deliver on time and where both are high and where our resources are getting allotted. And that's why I clearly articulated that T&D and BNS, if you look at what we have, whatever orders we have got in the first 6 months, are those segments, which are core segments for us.
Thank you very much, sir, and wish you happy Diwali, you and your team, and all the best for future.
Happy Diwali.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Amit Anwani from PL Capital. Please go ahead.
Sir, am I audible?
Yes, very much.
Yeah. So my first question is on the non-core assets. If you would like to update on for the quarters 3 Shubham Logistics and also indoor real estate. And third part is VPL. How much was our investment and what are the expectations on exit gains? Yeah.
So I think let me start with VPL first. As mentioned earlier, the enterprise value is around 775 crores. And over the period of the next 2, till we hand over the asset, whatever cash flows come in would get adjusted to the enterprise value. So we get the benefit of whatever cash flows happen from now till that time. We expect this deal to be closing in the next 6 to 9 months, depending upon the necessary approvals. We believe at the current enterprise level, we have a gain of approximately 100 crores over the equity which we have invested. And this gain could be different depending upon the closing, whatever happens at the closing time, but it should be in this range. As far as the Shubham business is concerned, we are looking at more Shubham from a revenue perspective or more from a, I can give you both. As far as Shubham business is concerned, half one is 25, they've done around 62 crores, growth of 10%. And on an overall basis at the PBT level, we have become positive. So the margins are closer to 1.3 crores. On a Q1 basis and a half one basis, around 7.8 crores. So margin of around 10 to 11% and a top line growth of 10% as far as Shubham is concerned. On the indoor front, we have not done much sales in Q2, given that Q2 has always those challenges on Shah and all of that. But we expect sales to grow significantly in Q3 and Q4. We're expecting the OC of the last building to come anytime in the next 1 month. And once that happens, we should be exiting indoor fully in the next 2 to 3 quarters itself. We think healthy traction there, and we believe that that would definitely be possible.
Sure, sir. And just to reconfirm, are we maintaining our guidance given during Q1 on revenue front? Because I can see H1 is about 5% revenue growth and H2 after it is quite high. So that is one. And second, on PBT, last time we guided 4.5% to 5%. So are we maintaining these guidances for console level?
So at a PBT level, we definitely believe that we should be in that range what we have guided for an annual basis. At a revenue level, we've seen some challenges in the water business, and that could impact some of our guidance on an annualized basis. Although on the next 2 quarters, we're pretty confident of a very healthy growth.
Sure. And lastly, on international T&D, you said there's been a pretty strong development there. Any specific geographies where you're sensing this? Because we are seeing geopolitically things have been unstable. We just wanted to understand which geographies in international market for T&D and other businesses are really becoming fruitful now.
For KPL, I think our opportunities on the international front, primarily a lot more in our two subsidiaries, which are Vijay Montage and Parcel, which are doing extremely well, driven by the Sweden, driven by the Nordic and the Brazilian market. We continue to stay bullish for the CIS in the Latin America segment also, where we today have leadership position across projects across Chile, Guyana, Suriname, all of that. Finally, we're seeing good traction in Africa and Middle East also, although we're not so much bullish on Middle East in the TAP segment driven by profitability constraints, but we're seeing good opportunities coming up there also. So if you ask me priority-wise, Europe continues to be the first, Latin America continues to be the second, driven by Africa and then Middle East.
Sure, sir. Thanks for taking my question. All the best.
Thank you.
Thank you. The next question is from the line of Ashish Shah from HDFC Asset Managers. Please go ahead.
Hello. Yeah, good morning. So just had a couple of questions. One, on the water business, you did say that the first half was slow because of the water collections being delayed. How are things looking on the ground now? Have has the government started disbursing the money and releasing payments, and are you seeing an improvement as we speak on the ground on water side?
Good morning, Ashish.
Good morning.
Ashish, we have significant presence in 5 states. I'm not getting into the detailing of each of the states, but I can say out of the 5 states, 3 states we have seen good traction in the last 15 days, where more than 70 or 80% of whatever was billed has been paid. But the other 2 states we see zero traction, right? So as with the other 2 states we have a huge amount which is outstanding for more than 180 days. And so we believe it should change soon. One of the states is just going into election, and one of them we've seen a government change which happened 3 months ago. So we are working along with the states. If you personally ask me, maybe it might take 2-3 more months for those states to come back to reality. But the 3 states, which is more than 70% of our order book, we have seen traction coming back. And to that extent, at least you'll see delivery improving in Q3. But are we back to normalcy across the entire business? The answer would be no as of now.
Okay. So would you expect this business or this segment to end at a similar level as last year, or it may be actually lower?
So our whole drive is to make sure that at least the growth slightly is compared to last year. Right? It's good for the division, it's good for the employees, it's good for the organization as a whole. That's the drive. But realistically, if collections don't improve, right, after a point it would be difficult for us to keep on pumping in cash flow to continue delivery. But yes, as of today, our internal drive is to make sure that they at least do minimum of what they did in the previous year, and as an organization we're driving towards that.
Right, sir. And also on the oil and gas business, the big pipeline contract that we have now, how do you see that shaping up in terms of the development cycle? When do the revenues hit the P&L, and how would you expect that contract to flow through our numbers?
I think the revenues have already started hitting the P&L. At least our revenue is not a profit till now, because we do not recognize profit till project which is 10% of its revenue. But on the revenue front, you've already seen Saudi Aramco coming in. Execution on the ground actually started on all the 3 projects which we have got. The team is fully there. The equipment has been mobilized. All the design is more than 50% of the design is already done. So if you ask me, as of now, the traction has started. What will be the peak? The peak will be next year, the entire 25-26 in terms of delivery. But in terms of revenue visibility, we've already seen that. That's why you've seen a 170% plus growth in Q2 and in the oil and gas business. And you'll see that similar traction going on for the next 4 to 6 quarters.
Sure. And just one last thing, on the domestic T&D pipeline, obviously you've indicated that a lot of your L1 orders are from the domestic T&D. How's the margin outlook for some of these orders? Is the competitive environment still benign as it used to be, and we are able to get these orders at a good margin?
Compared to what we have seen over the last 5 years, the margins are much better. It might not be those days which were there 15 years ago, right, of 15% plus, but definitely we're reaching that double-digit margin as far as T&D is concerned. It's a very healthy visibility today. And given the kind of work which is available, I think there's enough work for everyone whoever is in this field. So it's not a competitive drive, it's your ability to deliver which will define what work you can take. So today margins are improving, visibility is good, and competition is what it is. There's so much variability that I don't think competitive intensity would change the margin profile.
Got that, sir. Thank you. That's all, and wish you all a very happy Diwali. Thank you.
Thank you, Ashish. Wishing you and your family a very happy.
The next question is from the line of Suhadeep Mitra from Nuvama. Please go ahead.
Good morning, sir, and thank you for the opportunity. So thanks for the comments that you mentioned on the overall order inflow and margins. My understanding is that you are clearly focusing more on execution and margins, given that there is ample order inflow to be had. So just to focus on the order inflow piece, right? Given that you have a larger component that's coming from the India business, are you looking at a very large, chunky orders which could potentially come from the 2 or 3 HVDC projects which are currently under tendering? And what kind of, potential TAM can you build in for yourself?
So we already L1 in one large HVDC project, which has two, three specific components of that project, a substation and a couple of transmission lines. We already L1 in that, and we expect that order to come in anytime in the next 2 to 3 weeks itself. Going forward, yes, there are a lot of HVDC projects we are bidding, along with power grid and along with some of the private sector players. We do believe that we should be getting some more orders getting into the next 2 to 3 months. I do not understand the meaning of chunky, but for us, any order which is above 500 crores with a reasonable margin, with a double-digit margin is as good as anything else. So to put it differently, we definitely believe T&D order book will further go up in the next 6 months. We definitely believe we'll have some more orders coming in the HVDC space. The orders could be in the same sense of 500 to 700 crores. Individual orders could even be slightly less. And the next 6 months clearly looks like T&D domestic on the order front on all aspects.
Understood. So if I heard you correctly, I think you mentioned that each of these packages could be around 500 to 700 crores. And typically, if an HVDC project is worth, let's say, 15 to 20,000 crores, would it be right to assume that roughly 50% of that is what falls in the EPC bucket?
Yeah, I think it might be different. Including substation, at times it could even be more than that. But if you remove, for example, the transformer side of it, the HVDC instruments which are given, which are bought directly by power grid, then 40 to 50% would be EPC is the right estimate, including substation.
Understood. And in this specific HVDC bucket, my understanding is that there are very few qualified EPC competitors, right? So probably maybe 3, 4, or 5 players. So would there be a possibility of actually seeing better margins given limited competition and a large TAM?
I think, 2 aspects. I repeat what I said earlier, the competition is healthy, and we're happy with the healthy competition given that we have advantage on everything, right, from supply chain to design to delivery. As far as improvement in margin is concerned, definitely that's the intent, but let's be very clear that whoever is the developer, they also compete in a TBCB environment. So you cannot expect unrealistic margins because suppose the time with the developer and he loses and he loses the EPC project. So yes, margins are going to be healthy, they will improve, but they will not be unrealistic because it's a competitive market.
Understood. So you did mention in an earlier comment that you were looking at close to double-digit margins, at least in the T&D segment. That's more or less what we should assume.
Yes, for sure.
Perfect. That is understood. So my last bit is on the international, orders, especially the large chunky orders that you saw from Middle East earlier in the year. Given where hydrocarbon prices are headed currently, is there any risk of a slowdown in terms of, let's say, incremental ordering or even execution of existing order book from the Middle East exposure?
Today, we are largely working in the oil and gas on the Saudi Aramco order, right? We have started work on that entire, all the 3 packages which we have, there obviously could be some changes in the value there, right? That's driven by the nature of the business. But the size of the order itself is so big for us that at least from the next 18 to 24 month perspective, we have a hands full. Finally, we are already qualified at EDNOC. We are there in Aramco. We are there in a few more, countries in Middle East where we qualified for oil and gas business. We see good traction there for various reasons. One, because the capex in majority of the countries is on the uprise. Second, there are limited players globally who are doing this kind of projects. So I'm not so much worried about getting an order there. And at the current environment, at the current speed things are happening, I think delivery in terms of projects will also not be a challenge.
Understood, sir. Thank you so much for answering my questions.
Thank you. The next question is from the line of Vaibhav Shah from JM Financial. Please go ahead.
Thanks for the opportunity. Sir, firstly, when do we expect the cash inflow to come from the VEPL deal?
So, there are a lot of approvals which we need to take, right from bankers to the authorities to a lot of other agencies. We ourselves believe it could be anywhere between 6 to 9 months. We'll work hard to see if it can happen before March, but realistically it would get into 25-26.
And what would be the usage? So will we repay the debt in the other two assets, the third party debt?
It will be primarily for working capital.
And what could come in for the standalone company after repaying those third party debt?
I think, out of the total enterprise value of 750 plus crores, the external debt is closer to 350 odd crores. It's closer to 300 crores if I'm not mistaken. The balance should come to the company. Sorry, if my team is correcting me. 260 crores is our external debt and everything else should come to the company.
Okay. So secondly, we mentioned that we want to do a QIP up to 1,000 crores. So what could be the usage of those funds? And when are you targeting to do the QIP?
I think the board has yesterday approved the QIP process and now will be going to the shareholders for approval. The primary reason for the QIP would be utilizing it for working capital for the growth which is visible now. We are not in a position to review the timeline right now, except that the board has approved it and will be going to shareholders. And the value of the QIP is 1,000 crores and not 2,000. I think what has been approved is up to 1,000 crores.
Yes. Sir, and lastly, on the revenue guidance front, we had mentioned 20% plus kind of growth in the previous call. So can you give a particular number right now? What when can we build in for the entire year for FY25 on the standalone basis?
So, given the current challenges we have on our water business, where very different when we started the year versus what it is today, becoming difficult for us to give guidance in totality. As I mentioned earlier, all our businesses except water have done 20% plus in the first 6 months, except water and railway. I believe those businesses will continue to do well. And I also believe that Q3, Q4 will be much better than what we have seen in Q1, Q2. But given the current volatility of that situation in the water business, I'm not able to give you an indicative number, but I definitely believe that we might not be able to achieve what we had targeted at the beginning of the year. We could be slightly lower than that.
Okay. And sir, we had mentioned in the PPT that around 40 odd crores funding we have done for the road portfolio in first half. So what would be the number for the entire year and what would be the same for the next year as well, given the cash inflows would be coming maybe in first or second quarter next year?
I think we targeted for around 75 crores of inflow in the current year, and where we stand today, I believe we should be at similar numbers, plus minus by 10 crores. As I mentioned earlier, this entire majority of this amount is going to repay the debt because all projects the debt will be repaid over the next 3 years max. So it's only a timing mismatch more than anything else. So I think we will stand at a budgeted number of 75 crores and should be in that range as far as road projects is concerned.
And for 26?
Our 26 numbers is not yet particular to numbers, but in case the deal happens, obviously the numbers would, in case the cash flow comes in, which we are hoping it will, the numbers would reduce significantly. It would be opposite, right? The funding would come from them to us.
Okay. And so lastly, over a longer time frame, what kind of EBITDA margins are we targeting? So currently we are roughly around 8.5% on EBITDA front on a standalone basis. So what could be our target over the next 2 to 3 years in terms of margin expansion?
So I think clearly we have articulated in the past also that we are more focused on PBT margins now, and I think that margin we definitely expect to improve by at least 25 to 50 basis points getting into the next year, and that's what similar you see at a EBITDA level. I think the more important thing is also to look at the Concall margins, right? Because today Concall business has a significant business which comes from our core T&D in Sweden, core T&D in Brazil, Chile subsidiary, a lot of them. So I think it's important going forward that to look at the Concall numbers also where margins have reached EBITDA margins closer to 9%. And I believe that number should only go up because there are no surprises left on that margin anymore. So on a Concall basis, I think the number should go above 9 sooner than later. On a standalone basis, I think you'll slowly see margins improving with a clear 25 to 50 basis point improvement coming into the next few years.
Okay. Thank you, sir. Those are my questions.
Thank you. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. Am I audible?
Yeah, Deepak. Good morning. You're audible.
Yeah, good morning. So just wanted to check the Q1 increase in our finance costs when our sort of debt levels have gone down due to improved collections. Any effects or any other factor that has caused our interest expense to increase on a sequential basis?
No, I think it's primarily driven by 2 aspects. One, our volume was significantly higher for the first 2 months of the quarter. As I said earlier, because the water money started coming in later part of the quarter. Second, interest cost has been slightly higher driven by customer advances, where interest rates are more in the range of 9 to 10%. And given our improved order book, we have advances also which has slightly gone up. But as I said earlier, on an annual basis, we're still targeting our interest cost as a percentage of sales to be below 2%, with net working capital as a percentage. So it's only a timing issue of Q2, and I expect this to improve getting into Q3 onwards. On an absolute amount, obviously with the growth, the interest cost is going up, right? And it was expected because it's slightly higher than the revenue growth, but timing issue more than anything else.
Sure, sir. And maybe just from a revenue perspective, I think we understand this year, water has been slightly slow and we may be lower than the 20% number. But given that, the backlog is closer to 60,000 crores, should we see a sharp uptake in 26 and 27? How are we looking at it? Ex of water, if we look at all of it, how do we see growth beyond the current year as well?
I think the current order book clearly gives us good visibility even for next year in terms of very good growth with improved margins. I would not like to quantify that growth at this stage, given that we still have the next 5-6 months to build an order book or to get into a definitive situation on various aspects. But with the current order book visibility, I think a healthy growth with improved margins is visible for sure.
Sure, sir. Those are my questions. Thanks for understanding for future quarters.
Thank you. The next question is from the line of Parikshit Kandal from HDFC Securities. Please go ahead.
Hi, Manishji. Congratulations on a decent quarter, sir. So my first question is on the domestic T&D. So you said that there's a L1 sitting in your order book on HVDC side. So if you can quantify that, and what is the HVDC pipeline right now?
So in the domestic business, we have L1 of closer to 5,000 odd crores, as I said earlier, around 5,500 crores. And HVDC of that would be closer to 3,000 plus crores. Which in front of me is closer to 3,000 crores, including the substation business. So out of the 5,500 crores, 3,000 plus is HVDC, where Power Grid has already won the reverse auction or the TBCB bid, and they've got clearance from the government to go ahead with the project. So we expect that the awards will come in anytime in the next 2, 3, 4 weeks. Going forward, there are a couple of large HVDCs under bid now. I think the value could be in the range of 15,000 to 20,000 crores. All this happening in the next couple of months itself. We are working, as I said earlier, with Power Grid and with some private developers on those projects. I will not be able to quantify, our scope or what we're working on given the confidentiality at this stage. But definitely in the next 3 to 4 months, I think there are tenders for at least 15 to 20,000 crores on HVDC, which are then bid by REC and PFC.
Okay. So, what is the name of this project? Is it the Khavda one, sir? Or which one? What is this project?
Yeah, this is Khavda.
Okay. And the other connected question is beyond the HVDC pipeline, which may be very healthy for this year. So how do you think would the next year look from the HVDC side? And beyond HVDC, what are the other transmission opportunities in domestic, if you can quantify?
See, I think, the entire environment on T&D has changed significantly in the last 6 months. Right, driven by a lot of aspects. I think driven by the first aspect has been a refocus on thermal power generation, where you can see a lot of tenders coming by NTPC and other private sector developers on coal, the mega tenders coming in for which they will require the capacity to make sure that the delivery happens. Second, strengthening of the HVDC, which will continue going into the next year also. Third is looking at projects which are coming in Northeast as well as in Jammu Kashmir. And for the strengthening of the system itself, I'm sure you would have seen the NEP which just came out last month, where they have clearly said that the transmission capacity needs to improve by around 40% in the next 5 years to what it is today. So given that, I think visibility looks very good, right? And it's only about making sure that we can deliver on the stringent timeline. Because today, majority of the projects are 24 to 36 months. There's nothing beyond that. And that's more important for us to ensure that we deliver on stringent timelines. So for me, the next 2 years clearly looks like a very big bullish drive on T&D domestic, driven by all aspects which I mentioned earlier. We could easily see orders worth 50 to 60,000 crores only for EPC T&D coming in only on these 3-4 things, besides the state level orders which would be different. So we continue to stay very bullish. It's completely opposite to what I was in the last 3 years, where if you would have heard me, I used to say that in the T&D business, if it does 5 to 7%, we'll be happy. But now I'm saying that business definitely can look at a 20% plus growth, at least from a 3-year perspective, if not beyond that also. And with improved margins.
Got it. So, what is the timeline of this HVDC execution? I think you said in next couple of weeks or 3 weeks you will get the order. So, from then, how much time do you need to complete?
Majority of these projects are 36 to 42 months.
Okay.
And one of them substation which will be slightly low, but otherwise 36 to 42 months.
Okay. Well, so second question is on the fundraise. So you have announced 1,000 crores fundraise. So now if I look at the context, so you have monetized, announced a deal wherein you will get some money. You have claims upwards of 300 crores, which may get realized over the 2 years. So roughly, after repaying everything, you still have 750 to 800, and then Indore adds on top of it. So you will closely touch about 900 to 1,000 crores of inflows in the next 2 years. So what are you seeing? Are you seeing a deterioration in net working capital in the near future? Because even at growth of 15 to 20%, I think you will still be NWC positive in a scenario when you are looking at going below 100 days. So what is driving this fundraise? Is just that the market sentiment is favorable? That's the reason you're looking at it? Or so how do we read into it?
So I think this is a very good question, and this was the exact question which the board raised yesterday, and good to spend a few minutes on this. I think first thing is important to understand that majority of the business where we are capex intensive in the 1,500 cash flows. Right, which 30%, 35% of our free cash flow has gone only in capex in the last 3 years. 40% has gone in working capital, and the balance 30 has gone as dividend and interest payment and all of that. So when we look at the next 3 years, given the healthy order book, we realize that it's a combination of 3-4 things which we need to take care. First is the capex drive, because without capex, a lot of projects might not be delivered. Whether it is the B&F where you need staging scheduling, whether it's oil and gas in Saudi or wherever else where you need equipment, whether it's the international transmission line requirements where you will have to send because there's no capex in those countries, or whether it's the plant expansion, right? Our capacity of around 220, 230,000 tons, we might need to revisit that and look at expansion there also. So it was first driven by a requirement of saying that how much do we need in terms of capex to make sure that the healthy growth continues. Second, the reality also is that while we've been able to manage working capital, it's becoming more intense because a lot of projects are now milestone-based payments which are back-ended. We always had the 10% retention, but we we also have milestone-based payments. Right? So given that also, it was important to make sure that given the growth rate for the next 3 years, we have enough liquidity with us. Third, the timing of all that cash flow, which you said, could be 9 months, could be 12 months, could be 15 months, because they're dependent on external factors. But we'll go back to get it. Because remember, the same projects we have arbitration awards also, which we have won and which we have declared in the last 2 quarters. Now, obviously, we have arbitration awards to be taken from the client, and we'll go to them for NOC approval of that. It's not going to be an easy journey. Yes, we want to walk through it. It's not going to be an easy journey. So to that extent, there is a timing issue which could also be there. Right? And fourth, in the current environment, we believe that it's better to be on the right side of the banking environment with stringent norms on a lot of ratios. And so it's better to be on the right side on all the ratios from banking environment, and this would help us achieve that also. And fifth and the most important, our last flight we did in 2010. And from 2010 to now, the organization has grown more than 15 times, right, through internal cash flows. So I think it was a mix of all 5, 6 of them which do that. The market has been like this for the last 12 to 18 months. So it's not driven by necessarily the market sentiment. Yes, it helps for sure. It was a mix of the scope, I think. Added to that, clearly we have opportunities of acquisition also in the manufacturing space within where we are. We're not going to diversify anything. And that's something also which we have not looked very closely, given that all our cash flows are already blocked for working capital and capex. So I think it's a mix of all of those 5 and 6 things which help us to say that what do we do? And that's why the board immediately approved saying that this could be a good step looking at a 3-year to 5-year perspective.
Okay. And sorry, you said into manufacturing. Sorry, your voice was a little bit was not.
Yes, manufacturing opportunities within the sectors where we are. There's no diversification, but get into the value chain within that. So our plants, they are already doing staging shuttering, they are doing girders, they are doing our T&D. They could do a lot more in oil and gas. They could do a lot more in water. They could do a lot more in urban infra.
So what do you mean by manufacturing, sir? I mean, is it like you're looking at something on the solar side, or the conductors? I mean, looking to increase set up conductor capacity. So what do you mean by manufacturing?
So right now our focus is within the steel sector, within the steel segments, or I would say within the fabrication, galvanizing, and high-end fabrication sectors is what our focus is. So let's say the railway girders, the staging shuttering which we use for B&F. Let's say the pipes for water where welding is required, right? Oil and gas, whatever is required. So those things can still be done at a plant at Raipur, where we have a huge land available with us, and that's some expansion which we could look at. We've not zeroed down on anything as of now. What is the possibility which we could look at? But it is within the value chain of the businesses where we already are in. And I again want to remind you, majority of this plant expansion would be for our own EPC business.
Not into conductors and all. Now you're not setting up a conductor line.
Hello?
I'm asking you, are you also looking to set up a conductor line like some of the peers are doing conductor for backward integration and also to sell in market? So you have tower capacity, so looking at setting up, you have any plans to set up conductor capacity as well?
We're not looking at that opportunity as of now, but I do not know how things turn up in the future, but as of now, we're not looking at that opportunity.
Okay. And just lastly, sir, any exposure to Bangladesh? I think you were doing something on the power evacuation side for the Roper power plant. So anything there, any update on that?
So on the power transmission side, we completed the project 2 years ago. We have a small retention which is pending, but since it's funded, we do not believe a challenge in getting that money. On the railway side, we have a project which is funded by EXIM, where it's along with EFCON, we're doing that project. Again, on that project also, we are cash flow positive, and I do not see any challenges on that project also.
Are you been getting payments after the change in government there? Are you seeing any delays, or the payments are on time, or has the work stopped or restarted? So any update on that?
So we've not. So we first had to remove the entire team, which was done when all this happened. Now the teams have gone back in the last 2 weeks. We've obviously not raised any invoices because last 3 months we've not done any work. So I think the teams have just gone back, and I believe Q4 onwards the revenue will also start and collection should also start because it's all funded by EXIM. So I do not see a challenge in that in any form.
Okay. Okay, sir. Thank you, and wish you happy Diwali. Thank you.
Thank you. We also very happy.
Thank you. The next question is from the line of Ashwini Sharma from Emkay Global Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Most of the questions of mine have been answered. Just a couple of things. One is that if you can comment, Manish sir, on the tendering on the metro side, how are the activity over there? And secondly, on the water side, we understand, this year it is a little bit of challenging. How do you see pipeline in FY26 and, thereafter? Yeah, those were my questions.
Sure. Let me first answer the water side, and on the metro side, I will ask my colleague Amit to answer. On the water side, clearly, as I mentioned earlier, the first 6 months we've not seen many tenders come out. So post-elections, what we were expecting, a lot of tenders have not come out. We believe it's only a timing issue because as far as the Jal Jeevan Nigam, the entire plan is concerned, there's a lot more which needs to be done at a country level. So current year, maybe it could be subdued in terms of tenders, but getting into next year, we believe that those tenders should be back in every form. On the metro side, I will request my colleague Amit to just respond to this question.
Hi, Parikshit. Today, so far as metro segment is concerned, if you look at our population and our usage of metro per person compared to most of the other countries like China, US, and all that, we are far, far behind. And now that, there is no other option, as most cities that cross 25, 30 lakhs in terms of population, mobility is becoming a huge problem. And now that barrier is gone. Most of these are funded projects by JICA, EIB, ADB, etc., and they see that as a long-term, stable, sovereign guarantee from the Indian government to lend at very, very attractive rates. We've got, this metro in Nagpur, which we've just become L1. It's a 17-kilometer elevated metro. So, the size and scale of these metros are becoming large in individual packages, which make them very attractive for large players like us, because the sensible competition prevails there with 5 or 6 people who are all similar kind of peer groups. There is now a metro coming in Lucknow, Delhi, Bombay, Pune, all of these cities with a mix of underground and above ground metros. Kolkata are expanding. So I think from the next 2 to 4 year perspective, we already have visibility of which metros are coming, and we believe it's an attractive segment to be.
Sir, I just want to understand, is there any slackness in the current year as far as tendering is concerned? Is there a slowdown?
Typically, unlike a transmission, a metro takes a long time from a bid to an award cycle, because one, they have to go to their funding agencies and multilaterals for approvals, etc. at every stage. So that adds time from tender to award. Also, second, the time required for bidding, because these are very, very complex projects in terms of engineering during tendering phase. The entire tendering period also is much longer than, conventional projects in other businesses. So while there is the number of projects that have been announced this year, they've been a little slow because of government and a lot of code of conduct, etc. But I think next year onwards, as the cycle picks up, you'll have 5 or 6, 7 bids across various metros at any given time going on. So I think that little sluggishness that could have been there this year, not because of demand, but because of elections, etc., should ease out.
Okay. And last question to Manishji sir, at a company level, how do you see supply chain? Has our supply chain fully, completely improved? I mean, it's at a pre-COVID level, or still we are facing some challenges?
I think we're back to what we were at a pre-COVID, if not better than that, with a lot of people expanding their capacity also. We still have some challenges in some equipments, but that has reduced from a scale of 10, I would say, to 2. Yes, at times the global uncertainties do impact us, the entire thing, what happened at Red Sea and all of that. But again, just a timing issue, a few months here and there. But we'll be back to normalcy in 9 out of 10 cases, if not 10 out of 10 cases.
Okay, sir. Those were my questions. Thank you very much.
Thank you. The next question is from the line of Anuj Upadhyay from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, it's a follow-up on the 60,000 crores of opportunity you referred on the T&D space. So this is spread across over next 2 years kind of a time period. And with such a scalability of opportunity, how do you see the competitive intensity out here? And just to get a sense on how the margins could be across this project, because the overall market size has scaled up significantly.
So as I said earlier, the competition in T&D continues to stay healthy, and to me, actually, the competition is healthy across majority of our businesses except railways. Right? And healthy competition is always good for everyone. You know, everyone in the sector, everyone in the business is good for them. As I mentioned earlier, while we definitely see margins improvement from what we have seen in the past, but it can't go beyond a point because whoever the developer you are writing with, they also in a TBCB environment have to fight against the large developers. So yes, the margins are more large. They have reached a particular level. Personally, if you ask me, can it go significantly higher from there? My answer is no. Because it's still a very competitive environment, both at TBCB as well as at the EPC level. But it's healthy competition. You now don't see differences in tenders which are like 20, 25, 30%. You now see differences which are more 2, 3, 4%. And healthy competition is very good for all of us.
Got it, sir. And the 60,000 opportunity you referred is over next 2 years time period, because last week one of the asset developer had referred that close to around 1 lakh crores of bidding is scheduled to happen over next 6 to 7 months kind of a time period. So just want to get sense the 60,000 you referred was.
I believe this could happen in the next 12 months itself. You know, I said 50 to 60,000 on an annualized basis for the next 3 years is visible. So this is 50 to 60,000 on an annualized basis minimum. I think it could be higher than that. But on an annualized basis, it's not for 2 years. It's on an annualized basis.
That's helpful, sir. And lastly, on the pledge share, sir, in the last call you had mentioned that probably, the percentage of the promoter share might come down to a single digit. So any thought or update on that front?
No, I think you've got the wrong words. I never mentioned the single digit ever, right? I was very clear what I mentioned, that they would come down below 30%. Right now they're at around 23.46%. Clearly the intent is to continuously reduce it, and we believe that over a period of time this will come down. But over the history of this pledge, 18 years I've been with the organization, it's always been in excess of 30. Now they're at 23%, and this will continue to go down.
Got it, sir. Thanks for this. And wish you all a very happy Diwali, sir.
Thank you very much. Wishing you also very happy Diwali.
Thank you. The next question is from the line of Parikshit Kandal from HDFC Securities. Please go ahead.
So thanks for the follow-up. So my question is on margins. If I go a little back in the history, so 3-4 quarters back, you were more confident on doing a double-digit margin. Though your commentary on segment-wise margins improvement or reaching double-digit even in domestic T&D sounds to be positive, but the signaling on